Ladies and gentlemen, it is happening. The economy is breaking. Billionaire investors are beginning to panic, and CEOs, according to this billionaire investor, are miserable right now. I don't know about you, but what I'm seeing and what I feel we're on the verge of something huge. I feel like we've been building up to this bubble popping for years, for decades, and we've seen how they've just tried to kick the can down the road. Well, eventually we are at the end of the road now. Governments can't kick the can down the road anymore with so much debt. Central banks can't kick the can down the road with inflation so high. It is time to face some music, and this is going to be a very painful song, everyone. And we've just got some latest warnings from some billionaire famous investors about how bad the economy is, about how the stock market crash is going to get worse, and we also got some new news for what's happening in the housing market. So everyone, this is going to be a good one. You're definitely not going to want to miss this. So let's not waste any time. Let's get straight into the news, the facts, and the data. So listen to this, everyone. The economy is breaking hard and CEO confidence is miserable, says billionaire investor Barry Sternlich. Well, he's not wrong there. The economy is breaking hard. We've had 2 negative quarters of GDP, and that means we're technically in a recession, but they still don't want to call it that. But I think we're going to get more and more data to show how bad this recession is going to be, and it could lead to a depression. We're seeing consumer confidence fall, we're seeing debt skyrocket to record levels, and the real pain hasn't even begun yet. The economy is breaking hard, the chairman CEO of Starwood Capital Group told CNBC. If the Fed keeps this up, they're going to have a serious recession and people will lose their jobs, he added. Well, unfortunately, people, this is what I've been trying to warn about. I've been saying the Federal Reserve is really in a tough situation and they're in a lose-lose situation. They've backed themselves into a corner and there's no way they can get out of this inflation problem without bringing the economy into recession. It's the only way they're going to be able to bring down inflation. They'll try to sugarcoat it at the start of the year by saying, look, we can hike these interest rates. You know, there'll be a soft landing, or really even before they're saying, look, we're only going to have to do a few interest rate hikes. Well, we know that's not the case. And with the latest CPI data showing that inflation is still accelerating, well, they're going to have to get more aggressive. And a lot of people don't realize they're going to have to go higher than what they said of a 4% federal funds rate. And we're starting to see this too in the economy now, where we're seeing company after company announce, okay, we're going to be doing layoffs, and then more layoffs. We're also seeing companies stop hiring. So what people have to know is during a recession is unemployment is actually a lagging indicator. Once a lot of companies see that we are in a recession or the headlines start coming out, once consumer confidence starts falling, that's when the layoffs begin. It doesn't begin before the recession. He says consumer confidence is terrible and CEO confidence is miserable. Supply chain issues are being resolved and inventories are now backing up in the warehouse, which will lead to huge discounting, he said. Well, let's just take a minute, everyone, for those poor CEOs with their average salary of $10 million per year. They're really doing it tough. So yes, while supply chains are somewhat getting better, well, there's about to be a railroad strike, which is going to be a huge spanner thrown in the works for the supply chains. The supply chains are only going to get worse if this railroad strike goes through. That's going to mean there's not enough goods there and it's going to accelerate inflation. They're saying this could cost the US around $2 billion per day. Agree with him as well. Inventories are building up. I don't know if you've been in the mall lately, but I've seen heavy discounting. I've seen a lot of buy one, get the second free, or get the second one half price. They're trying to bundle up product because they thought this spending frenzy when the stimulus checks came out would go on forever. Well, unfortunately, it's not, because all people's money is going on rent, gas, utilities, and food. The middle class just simply doesn't have money left over for discretionary spending anymore. He warned the continuation of rate hikes will cause a major crash in the housing market. The once hot real estate market is swifting slowly down, with mortgage rates for a 30-year fixed rate loan over 6%, up from 3.29% at the start of the year, according to Mortgage News Daily. Again, I think he's stating the obvious here. There is going to be a big housing market correction and even a crash if they keep on lifting interest rates higher, which I think they're going to have to do. So I think if the Federal Reserve keeps doing these 75 basis point hikes, it could not be long until we see mortgages with a 7 in front of them. And remember, like they stated here, they're only 3% at the start of the year. So if interest rates go from 3% to 70%, borrowers and home buyers are going to have their purchasing power reduced by about 40%. And we all know the housing market relies on credit, so it's just simple economics. Housing market is going to have to reprice these high borrowing costs. Housing was already so unaffordable with interest rates low. Now that mortgage rates are more than double, you can't justify these high rates. And these hedge fund investors that have been buying up entire neighborhoods neighborhoods know this, and they're pulling out as well. Like how I did a video where Blackstone announced they're not going to be buying any more homes at the end of this month. Now, I was about to say something here, and this is what I've been worried about. I've been worried about this huge inflation problem. I know that the Federal Reserve is going to have to lift interest rates, which will cause a huge recession or even a depression to bring this inflation under control. So one thing I've been worried about is for all of a sudden these billionaire investors, these think tanks to come out and start saying, you know what, inflation's good. Actually, instead of 2% inflation, we should have 4% inflation, because if we have high inflation, you'll get a pay rise. It's a really great thing. And this is what I've been very, very terrified that's going to happen. And this is what this billionaire investor is calling for now. Listen to this. He said, while the Fed's target is 2% inflation, inflation should run at 3 to 4%. Inflation that is driven by wage growth is fabulous. We want wages to go up, he said. You can pay higher rents, you can buy your equipment, you can go to the restaurant if you have high wage growth. Now, this is something that is absolutely not true. If the Federal Reserve aims all of a sudden for 3 or 4% inflation, we all know the real inflation figure is double than that. And he's saying here, well, it's great because your wage will go up. Well, we all know, and we've actually got the data that in real terms, wages are falling because wages aren't keeping up with inflation. So if he all of a sudden starts advocating for 4% inflation, do you know what that will mean in real terms? Real inflation will be 8% and your wage will only be going up 2 or 3%. So really, like what we've been seeing with the middle class standard of living declining for the past 30 years, this will just make this problem worse. And I really hope the Federal Reserve doesn't listen to these billionaires calling for this. As for when the serious recession will hit, he believes it's imminent. And I agree with him there. I think the fourth quarter, I think right now, he said, you are going to see cracks everywhere. And we are already starting to see those cracks, people, again, with negative GDP growth, with consumer debt at all-time highs, with companies starting to layoffs, with the stock market crashing, bond market crashing, cryptocurrencies crashing, even gold and silver is taking a hit, but gold is holding up way better than stocks and it's outperforming its rival Bitcoin. So if you aren't noticing them yet, the cracks are everywhere to see. We've also got another warning from a huge famer investor, Ray Dalio. And this is something I've been wanting to do the math on. This is something that I've been thinking and something I agree with him. Let's get into this latest warning he has here. Listen to this. Ray Dalio does the math. Rates of 4.5% will sink stocks by 20%. He says private sector credit growth and spending to come down. He notes investors may be complacent about long-term inflation. So I think he's right on the money there. We've already seen stocks fall 15 to 20% in the S&P 500 and they've fallen much more in the NASDAQ. So I do agree with him. On top of this decline, like I've been warning about, if rates go above 4%, which is a very dangerous level, because what you have to know is every time the federal funds rate or interest rate on bonds increase by 1%, guess what that means for the government? That's an extra $300 billion in interest payments they have to pay every year. Now, during the lows of 2020, when they were spending like crazy and thinking, it's just going to be free money forever, interest rates were just 0.5%. So if interest rates go to 4.5%, guess how much interest costs are going to increase for the government? That's right. That's an extra $1.2 trillion a year just paying off interest. Not investing in schools, not investing in healthcare, not investing in infrastructure, just to pay off their huge skyrocketing debt, which is just getting worse. So like it's warning here, that means government spending is going to have to slow with high interest costs. The private sector, these large corporate companies, why their CEOs are so miserable, because they're going to have high interest costs. Their spending is going to slow, unemployment is going up, and then consumer spending is going to slow. And how the stock market works, it goes off price to earnings. If we know stocks are already very highly overvalued, but they're saying, look, don't worry, the reason they're overvalued because earnings are going to go up. Well, if earnings don't go up and earnings fall, which is simple economics, prices in the stock market are going to have to fall by at least 20%. Like interest rates will have to rise a lot towards the higher end of 4.5% to 6% range. Dalio also noted investors may still be too complacent about long-term inflation. While the bond market suggests traders are expecting an average annual inflation rate of 2.6% over the next decade, his guesstimate is that increases will be around 4.5% to 5%. With economic shocks, it may be even significantly higher, he added. And he's right here. Investors have been complacent about long-term inflation. Remember, they first said inflation was transitory. Well, they were wrong about that. Then the Federal Reserve says, don't worry, we've hit peak inflation. Well, they're wrong about that. Inflation is still surging. Like I've been warning about, what if inflation doesn't go away? What if it gets worse like the 1980s? And what if they have to lift interest rates up to 10% to stop this inflation? Guess what? The stock market is going to absolutely collapse. We will see a 50 to 75% collapse in stocks. We're going to see the biggest housing market crash, way worse than 2008 if this happens. Again, I'm not saying it will happen, but this is a risk investors are very complacent about, like Ray Dalio is saying here. The S&P 500 is heading for its biggest annual loss since 2008, while treasuries have suffered one of their worst beatings in decades. And this is something I think investors aren't thinking much about. What happens with people's retirement funds, their 401ks, or in Australia, their superannuation? Well, as people get close to retirement, what a lot of these investment funds do is put their money in treasuries, which are meant to be safer. Bonds are meant to be safer. But what have we seen happen to bond prices? Bond prices have fallen 30% over the past 2 years. They've been getting absolutely hammered. And all these people that were going to retire on $1 million to $2 million nest egg, they're seeing their wealth evaporate before their eyes. And that means they're going to have a lot less spending in retirement. And the baby boomers are the wealthiest generation right now. So if they lose a lot of their wealth, well, that's going to be big consequences for the economy. It's going to be big consequences for the markets. And look at this, just how much wealth has been destroyed from this market crash, and people are warning it's only going to get worse. Bearstein Quant says 7.6 trillion US bear market has more to go. Markets are vulnerable to hawkish Fed and growth jitters. Did you hear that, everyone? $7.6 trillion has been wiped out just over the past few months during this market crash. If you don't think that's going to have big consequences for the markets, for the banks, you have to think again, and you really have to do your research. That's nearly half of the US GDP. And like I showed you in my previous video, the US household wealth suffered a record drop in the second quarter. And you know what's really shocking? There's still people that are in denial that there's no crash, that there's no crash coming, or we're not even in a crash. People, we are in the middle of an economic crisis. We're seeing currencies fail like the Turkish lira. We're seeing literal countries collapse like Sri Lanka. The dollar skyrocketing high is going to create a huge foreign debt crisis because other countries are experiencing hyperinflation with a higher dollar. Well, then that means they're going to have to use more and more of their currency to repay the debt. We're seeing a huge energy crisis in Europe, which is going to bring Europe into a depression. I don't care what the economic figures say. If people can't afford to buy food and heat their home, we are in a depression. We're seeing more and more conflict in the world, and it's only going to get worse as people get hungry. But let's get back to this report that tells us how worse things could get for the markets. An analysis of 15 major routes since 1937 shows peak to trough price drops average 28%, deeper than the current drawdown of 20%. The average bear market lasted 7 to 8 months and included 3 rallies with returns of 9% and lasting about 22 days on average, in line with this year, they said. And you know me, people, I don't like to speculate. I try to back up everything I say with facts and data. And what history is telling us, what the data is telling us, this downturn is not over. And this downturn is unlike any other, because we haven't had debt at such high levels, and we haven't seen interest rates have to go up so high relative to where they were before. You know, for example, when interest rates went up in the 1970s and 1980s of say 5% to 15 to 20%, when you think of it, that's just tripling or quadrupling the interest rate. Well, what we're going to be going from to is 0.5% to 5%, 10 times higher than what interest rates were before. So even though it may seem like interest rates aren't going as high as what they did in the 70s and 80s, while with debt so much higher, it's still going to have the same effect. But what is yet to see a big correction yet is housing market. And again, people, the housing market is very slow to react. It's not like the stock market where it can crash 20% in a couple of months. It takes time to play out. And remember, the downturn in 2008, it didn't happen in a few months, people. It took 3 years to play out, from 2008 to 2011. So a lot of these experts are saying, don't panic, prices haven't dropped yet. Well, they are dropping in many areas, especially California right now. There's some areas where prices have already dropped 10% in just the past few months. And what a lot of their comparisons are doing is year-over-year growth, when there was a lot of growth in 2021. Well, what they're not showing is the falls we're starting to see now. But once they do start comparing year-over-year figures from a few months ago, well, we will start to see those price declines in the market. And remember, interest rates are not at their peak yet. And this is what I keep warning about. Interest rates are going to go higher. So that means even if people think the housing market won't crash at these interest rates, which they're definitely going to, well, it will definitely start to show themselves once mortgage rates go to 7%. Look at this. US mortgage rates surpassed 6% for the first time since 2008. And rapid rise in cost of borrowing is putting pressure on the raging housing market. So just be patient. We will start to see house prices fall. And once they start to fall, we're going to see a domino effect. And once confidence in the housing market finally starts to fall, because we still have a lot of people in disbelief that the housing market won't fall. But once these people do start to see their price declines, we'll get FOMO, a fear of not getting out of the market. We'll see sellers start to discount their prices heavily, which they're already starting to do. And once buyers start to see prices are falling, they may think, hey, maybe I'll just wait another 6 to 12 months and I'll get that home for a cheaper price. And that means this inventory problem, which we've had for the past year, 2 years, well, there's going to be oversupply, which what we're already seeing in the new homes market. So everyone, that was just a quick update with what's going on in the economy, the markets. What do you think? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.